Hello, this is a synopsis of Chapter 1 for Finance 356. And Chapter 1 is just a general overview of investments with some pretty simple definitions. So I just wanted to go through it rather quickly and just focus on a few points here. All right, so when you're thinking about constructing a portfolio, one thing that you have to think about is what is your goal? Are you investing for the long term or the short term? So let's start with this slide. Just talking about income. We receive income. We either spend it or we save it. So if we're going to save income, then we are investing it. If it's short term, if our goal is short term, then we would just have it in a money market account or a savings account where we're just earning very little, but we're not taking any risk. So if you invested your money in, as I said, a savings account or a CD, certificate of deposit, or a money market account is an account that invests in short-term government bonds. You're really taking very little risk, which would be the case if you need the money short term. And by short term, I mean a year or less. Really, if you're saving and you need the money, I would say 3 years or less, you would want to be in pretty safe investments. However, if you have a longer time horizon, 5 years or more, then you can invest in the stock market and take some more risk because you have time on your side if there's a downturn. So anyway, income is either saved or spent. Obviously, we invest our savings depending on our time horizon. That is going to dictate our investment. So a combination of your investments will constitute a portfolio. So when we say portfolio, we're talking about not just we're talking about physical assets plus monetary type assets. So a portfolio could consist of your savings account, a stock account that you might have, some mutual funds, maybe a retirement account. Also, if you own a house or own property, that you should also think about including that. That's all part of your portfolio. So real property, real assets, and then financial assets. All right, so of course you have different objectives, different investment objectives. Ideally, you should have around 3 months of income saved for emergencies. So I guess if anything taught us a lesson, COVID taught us a lesson regarding it's good to have a nest egg because you just never know what can happen. So, most people don't even have a month, but most financial planners will say 6 months or 3 to 6 months, but I think 3 months is reasonable. To try to have 3 months of make a goal to have 3 months of your monthly income in savings that you could access in case of an emergency. Then you may also be saving, if you have kids, you might be saving for their education expenses. So if you're saving, if you need funds for education expenses, depending on the time horizon, if it's small children that you're saving for, then you can have some of the money in the stock market because you have a long-term time horizon. But if you need funds right now to finance your education expenses, of course, that's short term. Then you might be saving for a specific purchase, a car, a home. So, it just depends on your risk tolerance, how much of that you would want in the stock market and how much of that you would want to be in a safer investment. So, if your time horizon is 3 years or less, probably not wise to put it in the market. But if it's longer than that, you could maybe put some in the market. And then obviously for most of us, funds for retirement, that's long term. Definitely, in my opinion, you should be 100% in the stock market if you're making investments for your retirement, because you have a long-term time horizon. And if the market corrects, for example, 2007, 2008, the market went down almost 50%. It was back in 5 years. So even if you have a correction like that, time is on your side. So what people generally do is they'll be 100% in the stock market. And then as they approach retirement, then they will change that percentage. They'll put some money in cash, or they'll transfer some of the funds into bonds. That's a little less risky. But But then other people have this philosophy. I mean, that's conservative to switch over to more of a percentage of bonds or cash as you approach retirement. But let's say you retire at age 65 and you're probably going to live another 20, 25 years easily. So that's, you still kind of have a long-term time horizon. So some people will still keep some money in the market. Some people who are real risk seekers will still stay 100% in the market, but there's nothing wrong when you're in retirement still having some money in the market, because again, you still have a long-term time horizon. Even though you're not earning income anymore, there's no reason why you can't be invested in somewhat in the stock market. Okay, so the bottom line here, the main takeaway is you want to have different risk tolerances based on the time horizon, and the shorter your time horizon, the less risky investment you want to be in. So let's just look at some of these other definitions here. Primary versus secondary markets, you may be familiar with that from Finance 302. The primary market is when a stock is initially, when a company has an IPO, the initial public offering. The first people who can buy the stock are people who have accounts with a particular brokerage house that is issuing the stock. So actually, I've been talking about Robinhood. When you see some of the later synopses, later chapters, I mentioned Robinhood. They're a brokerage account that you can get. It's online, or you can download an app and get a Robinhood account. They actually are starting to offer IPOs that you can be involved in if you want to. So if you are the first person to invest in a stock before it goes public, or as it's going public, that's the primary market. So as the first investor, as soon as you sell that stock, that's sold on the secondary market. So the stock indices, these markets like the New York Stock Exchange and the NASDAQ, those are secondary markets. So that's where stocks are bought and sold once they've been issued. All right. The value versus valuation. The value would just be the price of the stock. Valuation is when you are actually trying to value a company. What price should the stock be at? So I guess another way to think of this is the stated value versus the intrinsic value. What is the stock really worth versus the actual value? And so in the long run, we would see an equilibrium between these two, the actual stated price and what the price of the stock should be. But in the short run, on any given day, these aren't in equilibrium. The stock may be undervalued or overvalued depending on the news, depending on what I call noise, whether there's a lot of exuberance about the company, or people are, there's some bad news about the company, or it's out of favor, so to speak. Okay, so valuation is when you're trying to actually figure out what the price should be. Value is what it is. All right, then there's two ways to make money in the markets, in the stock market. When you buy and hold a stock, I'm just going to talk about this. I think what they're referring to here, what I'm talking about here, is dividend income. So the way you make money in the stock market is through dividend income and capital gains. If a company pays a dividend, you're going to get the dividends, and you have dividend income. The other way to make money is by the increase in the stock price. So if you buy a stock for $100, one share goes up to $200 after a number of years, you've made 100%. So that's the way you make money in the market: dividends and capital gains. All right, and then when you're thinking about returns, if you're trying to figure out your return, well, you can say, how much money I've made, but it's better to think about returns in percentages. Because let's say that I came into class, if this were a face-to-face class, I came into class and I said, well, I made $1,000 on this investment last year. And then someone in class says, oh, well, I made $1,000 too. And I was invested too. And I say, okay, well, then we start talking and I say, well, I had $10,000 invested and I made $1,000. And then so that would be 10% return. And then someone in class says, oh, well, I only had 5,000 invested. I had $5,000 invested and I made $1,000. So you see, we both made $1,000, but just talking about it in monetary units doesn't really tell you the whole picture. It doesn't let you compare apples to apples. So it's better to express your returns as a percentage, because in that example, I made 10%, but the other person made 20%. So that's what they're getting at there. Okay, and then risk. Risk is just basically the possibility of a negative return. So possibility of a loss, may also the uncertainty of future returns, and so forth. So we are, we all face a certain amount of risk. So in the different investments that we have, the higher the risk, the more return that we're going to want to have. Risk is differentiated from speculation, and that speculation is just taking undue risks. So, if you have a diversified portfolio, you have basically diversified away what we call all the diversifiable risk. And so that's the risk of, certain bad news about certain stocks or certain individual equities going up and down. So by diversifying in a lot of different industries, you can get rid of that diversifiable risk. But you still have what's called non-diversifiable risk. And non-diversifiable risk is risk that's endemic in the entire economy or the entire market. So let's say, like when COVID happened, well, that was non-diversifiable risk. Market went down quite a bit in March. So if the economy goes into a recession, if there's a terrorist attack, the Feds raise interest rates, that would cause the market to go down. So non-diversifiable risk is risk that it doesn't matter if you're diversified, it's still going to affect you. Another way to think of that, another way it's stated, is unsystematic versus systematic risk. So diversifiable risk is unsystematic risk. Think of that as not associated with the system, so to speak, the economic system. And then non-diversifiable risk is called systematic risk. Okay, speculation is just when you're way out there. Day trading, for example, would be speculation. In my opinion, buying Bitcoin is speculative. Going on Reddit and trying to follow these threads on Reddit and make a profit with GameStop or AMC, those are speculative. That would be speculative behavior. Okay, so generally most of the stocks that we invest in, most of the investments that we undertake, they are marketable. They're traded fairly frequently. They're pretty liquid, and the depth, there's a lot of depth in the market. So this is the case with most of our investments. Getting to liquidity here, let's say that you were thinking about investing in real estate versus investing in the stock market. Well, real estate obviously is not going to be as liquid as investing in the market, because you can just go into your account with the click of a mouse, you've bought and sold. But it's a little bit harder to buy and sell real estate. It's not quite as liquid. So what some people will do is, instead of buying real estate proper, the actual real estate, you can buy these investments. It's these mutual funds or these exchange traded funds, which are called REITs, REIT, Real Estate Investment Trust. And that's just a mutual fund or an exchange traded fund. And let me back up for a second. You guys probably know a mutual fund is just basically a company that's pooled people's money and buys a lot of different equities. So you can be very diversified. An exchange traded fund is just like a mutual fund. Again, they've pulled people's money and they're buying several different equities. These exchange traded funds differ from mutual funds in that these exchange traded funds, not always, but they tend to be based off of an index like the S&P 500 or the Dow Jones Industrial Average or the NASDAQ. Also, these exchange traded funds or ETFs trade like a stock. The price changes throughout the day. And whereas a mutual fund, you just get the end of the day price. They add up all the underlying securities and you get the end of the day price. So anyway, back to liquidity. If you wanted to say invest in real estate, but be more liquid, you can invest in an ETF or mutual fund that invests in real estate. It's called a REIT, REIT. And these are funds that are invested in companies that invest in commercial real estate, things like, shopping centers, shopping malls, apartment buildings and so forth. So you can still have some exposure to real estate and be liquid. And I have found, and this is true, a lot of these REITs, they tend to not be as volatile as the stock market, as the market in general. So it's a good way to diversify because they don't. Sometimes they'll even act in a negative. They'll be negatively correlated with the market in general. So if stocks go down, the REITs can actually go up, or vice versa. Or they don't go. They're not as volatile. They don't go up by as much, or they don't go down by as much in the downturn. Now, what's going on right now, summer of 2021, is we're looking at an economic landscape of more than likely increasing interest rates. So as interest rates increase, that could put pressure on these REITs and cause them to go down a little bit. But anyway, that's what we mean by liquidity. All right. So how can you diversify? Well, you can diversify among a lot of different specific assets. Stocks, you can buy bonds, government bonds, corporate bonds. So of course, with a bond, you're going to get a rate of return. You're going to get interest payments on these bonds. So you don't have the bonds are not nearly as volatile as stocks because you buy a bond for a specific amount, it's usually $1,000 increment, and you get the interest payments. Then at the end of the bond's life, you get your $1,000 back. You can also buy mutual funds or ETFs that hold a basket of bonds. So people will buy bonds if they don't want to take on the risk of stocks. But here's the problem with bonds, and here's what's going on in summer of 2021 and has been going on for about the past year or two. We're in a situation with increasing interest rates. Well, this is called price risk with bonds. As interest rates increase, the price of a bond is going to go down. So I don't find personally bonds to be a very good hedge because in this particular environment, the prices can go down. So you can invest in a bond mutual fund and you're getting your interest payments, but you are the price of the mutual fund or ETF is going down. So I prefer to go to cash if I'm going to get out of stocks for a little while or sell some stocks or go into a REIT. Okay, so anyway, you've got stocks and bonds. Money market instruments, as I mentioned, that's kind of like holding cash. It's not totally risk-free, but they're holding short-term government bonds for these money market instruments. And so very little volatility, and you make a small rate of return. People like to hold precious metals. When gold and silver were doing terribly for the past 5-6 years, and then COVID hit, and all of a sudden they're up again. So precious metals are good to hold. They're a good hedge if everything is very negative in the market and in the economy. They tend to have a negative correlation with the stock market in general, but not always. So if you want to hold, I don't suggest holding physical gold or physical silver or physical platinum, physical precious metals. What I would suggest is you can buy an exchange traded fund that holds these. some of the more popular ones are GLD is an ETF that invests in gold, SLV, an ETF that invests in silver. So when you're thinking about what to invest in for the contest that we have in this class, maybe you want to buy some SLV or some GLD, and just to watch that. Okay, and then real estate, as I mentioned, you can buy physical real estate. You can also buy REITs, and that way you can have some real estate holdings, but have it more liquid. All right. In chapter 4, we're going to talk more specific about market efficiency, but in general, the financial markets are considered to be efficient because this is the main reason, really. Information is readily available. There's so much information out there. Now, you're going to see in chapter 4, if you have inside information, then the markets aren't efficient. So what the efficient market implies is that you can't beat the market. You cannot consistently outperform the market, or you can't make abnormal returns consistently because the markets are efficient. In other words, you can't gain one over on the market. But if you had inside information, of course you could. For example, if you knew ahead of time that the FDA was going to approve a drug, you could buy that stock before the approval was made public, and that would be a market inefficiency because you'd be making money. You'd have inside knowledge that no one else had, or very few other people had, and you would be making money on that. Of course, that's illegal, insider trading. But anyway, I'm just illustrating that that's an inefficiency, is if you have inside information. But most of, other than that, the markets are efficient. And they're efficient because most, information is readily available. People can readily exit and enter the financial markets, and there's competition among investors. The market is really just a pool of buyers and sellers. It's really pretty simple. If there's more buyers than sellers, there's more people buying than selling, the market goes up. If there's more people selling than buying, market goes down. It's just a basic auction, and it is efficient. All right. So this is just talking about how they're always talking about market returns. And by the way, the press is always saying, whenever the S&P 500 or the Dow Jones Industrial Average reaches a new high, they'll say, oh, the S&P 500 reached a record high. But that really isn't news. So just ignore that when you hear that the market is reaching record highs, because think about it. The market is continuing to go up. It'll have downturns now and then, but 70% of the time the market is up. So if the market is continually going up, of course there's going to be record highs. You're going to always reach you're going to continue to reach these record highs. It's not news. Anyway, and then also a higher return requires accepting more risk typically. And so when you're thinking about investing, here's the most important thing. You want to be able to sleep at night. So you want to take on the amount of risk that you're comfortable with. So, and since this is the first chapter, let me just sum up by saying this. The way to wealth, and when you think about investments, it's really easy to try to think about, well, I want to make money, and we're seeing all this crazy stuff going on in the market. Why couldn't I buy GameStop and make all this money? Or why didn't I buy Bitcoin when it was $500? Or, why didn't I buy Tesla when it was $10? You can't think in those terms, because that's like going to the casino and putting all your money on 0 or 00 or number 7, whatever. That's not the way you make money in the market. The way you make money in the market is not trying to get rich quick. Very few people are that lucky. Most people who try that, the majority of them are losers. The way you make money in the market is really boring. You invest systematically over time, and you buy the market. You get in a very diversified portfolio. You don't even have to buy individual stocks if you don't want to. You can just buy mutual funds and exchange traded funds, just index funds. Because believe it or not, most people and most of these professional managers with who manage these mutual funds, they don't outperform the market. So all you really have to do is, I would suggest buying some of these buy some of these index funds, and then maybe invest in a few stocks that you know about, but just in and that you're comfortable with. But you have time on your side because you all are young. So you just invest systematically over time, and it's a no-brainer. Your money's going to grow. You can't predict what the market's going to do in the next minute, hour, day, month, year, but you can positively say in the future the market will be higher. And that's basically this whole class in a nutshell. Is it's not rocket science with investing. You just invest systematically over time, and if you have time on your side, the power of compounding will do its work. Okay, so trading or investing, trading versus investing. Well, what I'm talking about is investing. You're investing over a long period of time. Trading implies day trading, or you're trying to get in and out of something and make some quick money. That's a fool's game. Does not work in the long run. Okay, let's see, what's this? Financial analysis. Okay, so another reason that the markets are efficient is because we have financial data that we can rely on. These companies' financial statements are audited, and we can rely on the use of these financial statements. That's another thing that makes the markets efficient. So what they're saying here is just that financial analysis is basically built on a certain set of assumptions that investors are rational and so forth, and that we prefer less risk to more risk. And we use historical data. We try to look at historical data to try to forecast future trends. Okay, and this is just some in the book. You can, if you're interested in a career in financial planning or in a financial analysis, you can read about these to see if you're interested in taking any of these exams. So I'll just tell you, this is a Series 7 license. If you work for a brokerage house, you'll end up having to take at least a Series 7. But these, I wanted to just focus on these two. Let's see, a CFP is a Certified Financial Planner, and so that's an exam that you take. It's a series of exams on different topics. So a Certified Financial Planner, definitely I would recommend that if you want to go into financial planning. It is an overview of investing and insurance, estate planning. It just gives you a really good overview of financial planning in general. Chartered Financial Analyst, a CFA, a Chartered Financial Analyst, that is much more robust than being a CFP. So if you sit for the CFA exam, that is people who want to go into financial analysis, really, behind the scenes analyzing investments. They sit for the CFA exam. It's a 3-part exam, or it's 3 different exams. Very low pass rate, very difficult to take. So, but that's more if you want to become a financial analyst. If you're interested in financial planning, then the CFP would make more sense. Eventually, you could become a CFA, but I would start with the CFP. Anyway, you can read more about these in the book. And if you have any questions too, feel free to give me a call or text me or email me. All right, so the internet. We're all getting lots of information now. There's a flood of information out there on the internet. Basically, it's all free. The problem is a lot of it can be inaccurate. So you have to take these things with a grain of salt. And, if someone's recommending a stock, you have to ask yourself, well, why are they recommending it? Are they trying to pump and dump it? In other words, have they just bought it and they're trying to get you to buy it so the price can go up and then they can sell it? Is it biased information? But there's some good information out there too. For example, if you have an account, not with Robinhood, but if you have an account with, say, Fidelity or with Schwab or with any of these brokerage houses, they give you access to um, an, analyst reports on these stocks. Schwab in particular is really good at giving you access to these reports, and it's for the most. I mean, it's they're objective reports. So there is some good information out there too, but you just have to weed through it. All right. So just make sure, there's another chapter in this book where we talk about behavioral finance. We all, I don't want to have time to get into it today, but basically what people have found, what analysts have found, is that people don't really behave rationally with their money. So make sure when we get to that chapter, you'll understand more what I'm talking about, but make sure that you know what your philosophy is, and that you understand yourself, and that you're not making rash decisions, and you don't fall into these pitfalls of not being rational with your money, is what I'm trying to say. Okay, so this is just a basic overview of the course. This concludes the synopsis of chapter 1.